One of the biggest challenges for investors, including financial advisors, comes on the investing side of your plan. There are thousands of possibilities and infinite numbers of combinations that can be used to build a portfolio. On top of that, we deal with an incredible force of the unknown. Today, Vince and Evan join me to discuss why investment selection is a true superpower. That's all coming up right now. Hello, welcome back to Wealth Wednesday. Thanks for joining us today. If you'd like to learn more about our firm, you can find us at cfswv.com and here on YouTube at Commonwealth Financial. Today, I'm joined by Vince McManus and a new face, Evan Brockmeyer, who's a financial advisor in Marietta, Ohio. Guys, I tend to believe we all have a superpower of sorts. Mine's reaching things on the high shelves because I'm 6'4" and building spreadsheets. I like to think being able to pick good investments would be one of them, but reality is that it isn't. Evan, welcome. Can you explain what I mean when I say that I'm not that alone in my abilities to be an investment picker?
Well, it's humble of you to admit that, really, because it's, the job that we do every day and pride ourselves on. And, we're as competitive as anybody else trying to beat the guy or gal down the street. But I think when you look at time horizons and trying to beat the market in a given year, so many things have to go right. I mean, you have to be right with your selection, first of all, and you have to be right with your timing. It's not always, good companies have bad quarters, good stocks get caught up in sell-offs, and, it's nearly impossible to get it right over a, short-term time horizon. And there's some data that will support that. The S&P publishes a scorecard each year that is a measurement of S&P performance versus actively managed funds. And pardon me while I read some data here, but 51% of large cap funds, so your GEs, your Chevrons, your blue chip companies, they lagged the S&P last year. And in a year where the market was kind of ripe for this kind of performance, it did not go well for active managers. So it's one of those things that you have to stay the course. And, in this case, if you had just picked an index fund, then you would have outperformed the market.
Vince, you like to dig into the weeds in this kind of stuff. The longer you go out, the worse these numbers get, don't they?
Typically, yes. One of the things a lot of people, especially advisors, tend to look at when picking investments for the future is their past results. I mean, it's the way everything is kind of advertised in this industry, and it drives me up a wall because you look at a lot of times, like if I were to pick probably a fairly easy strategy that I think would do okay and have a decent shot at beating a market, it was taking the sectors that performed well last year, selling those and buying the ones that did terrible. But that's the exact opposite of how our brain works and how the industry advertises for these types of things. What most people are going to look at is the last 1 year, 3 year, 5 year, 10-year time horizons. And that's what's advertised on all these fund prospectuses and everything that I'm getting sent to me via email or that I look up on the internet. And that's the way that a lot of people pick things. And what happens is a lot of times something that's up in 1 year is going to be down the next year or at least lag. And that's what makes this hard. Like being a long-term investor it's more about controlling investor behavior than investment behavior. It's just a very hard thing to do. We are not wired as human beings to be good long-term investors. That's why we need help. That's why we need a plan. That's why I have a job. So it's just the point of what we do. And it's just a very hard thing. Again, throwing some numbers out, back to the investment picking, looking at some of the past results, that 40% of actively managed funds generated better performance than the index in 20. By 2021, 10.6 outperformed. And then by end of 22, only 2.5% of those of the original 40. And that's what my point is. It's just a very hard thing to do because you have to be okay going against the herd, which again, as human beings, we're just not typically good at.
Evan, we made mention of having superpowers. These fund managers with support teams, computing power, and time to try to generate this outperformance can't consistently do it. How do mere mortals like the financial advisors on Main Street expect to do it?
Yeah, I mean, part of it comes with just swallowing your pride sometimes and just sticking to what market history has said works. And that's to stay the course and stay in it for the long term. I mean, Vince nailed it in the last comments there. It's not anything that makes headlines. But staying in it long term is what works. And you've said it oftentimes in past episodes and conversation, is the hardest thing to do more often than not is to do nothing. And that's ultimately what drives value in the long term. And I think there's another piece of this too that's important to recognize is, yes, we at Commonwealth, we do have an active management strategy, but it's not the whole strategy. It's how does that play into the bigger picture and what you're comfortable with from an asset allocation perspective, and taking advantage of times when the market becomes inefficient, which, at times is going to happen.
Vince, this leads us to a couple of different points, and I want you to comment on the first one. If the financial advisors you see on Main Street can't consistently pick winners, what should we be focusing on?
Well, we should be focusing on is very easy. We focus on our plan. That's the first thing. That's the bedrock of everything that we're going to do. Our investment allocations are based off of our plan, period. So if we start there and move to our investment allocation, we have a much better chance of getting a market return or slightly beating a market return because we can stay the course. One of the things I am constantly telling people from the first time that I meet them is that things will go bad. I don't know when, but I know that they will. And then the other part is that typically I'm getting people to embrace capitalism. I'm getting people to lean into being an owner and not a loaner. And what's being an owner mean? That means we own stocks. One of the things that we want stocks to do is to act like stocks. So again, the volatility sometimes that you see in markets, that is a feature, not a bug. That is what makes us our money over a long term. It doesn't feel like it at the time, but that's just how things work. Okay. So when we know it in the beginning that it is somewhat possible to pick in advance exactly the investments that are going to be winners, the idea is that we're picking a portfolio, we're building out a portfolio that over time we think has the characteristics that can win. And in the worst case, it's getting a decent market-based return. We're wanting to limit our downside as much as possible within reality of understanding how markets work. Again, it's not like if the market's down 30% for a year, I'm sorry, but we're not going to be up. That's not reality. If it does happen, that means we've got amazingly lucky that year and it probably doesn't happen again. But if we can be down a little bit less than the market at that time over a long time period, that's how we keep people invested and help them stick with their plan.
Evan, I saw a quote from 2008 or 2009 near the bottom of the great financial crisis, and this is what it says. Whether it is by allocation choice or just plain personal fortitude, taking and maintaining an aggressive posture will be a huge explainer of long-term returns as long as it is an aggressive posture you can maintain. Now, this leads to the second point. Investors benefit from equity returns as long as they can hold them and not sell them when things get ugly. Now, this leads to the second point. Investors benefit from equity returns as long as they can hold them and not sell them when things get ugly. In the quote, it talks about asset allocation and personal fortitude. That's the other area where we can help add value, isn't it?
Yeah, absolutely. I think personal fortitude is a great way to express it. And we as advisors are just as much of, coaches and therapists to a degree where we're managing behaviors, expectations, and attitudes. And as much as we're managing money and picking investments, it's one of those things where we take pride in not trying to shove everybody into the same box. It's not having an individual plan for each of you is going to drive what we do and how we do it. It's not one strategy fits all by any stretch. And we have to make sure that we're comfortable with where this is going, given your risk tolerance and what you can handle from a stock allocation perspective. If you can't handle a 50% market drop in a given year, then you're not going to be 100% stock. It's just the fact of the matter and how we have to approach our job. And it can be counterintuitive sometimes from an investment standpoint, but sometimes you do have to run towards that burning building when, so to speak, when stocks are on sale. And that's where we drive long-term value. within the context of your plan and your timing.
Vince, we live in a very competitive world, and it is easy to focus on investment performance. As we wrap things up today, what are some things that our listeners need to remember?
My biggest thing is that most people, your goal, it's not a realistic goal. It's not a goal that I think about or even talk about, is to beat the S&P 500. It's just not how I view this stuff, and it's not how an investor should view this stuff. Because what are you doing if that's your goal? You're setting yourself up to make an emotional decision. You're focusing on something that is bad. It's going to probably generate bad behavior if you're doing that. Where what I'm trying to get people to focus on, again, plan is the bedrock thing of what we do here. Without a plan, we're destined to fail, period. So what most people are looking to do, if we're talking about actual goals, is generate a retirement income that they can't outlive, pay for money to educate their kids, and then they have children or a charity or some other cause that they care about, to be able to leave them something whenever they leave this life. So all of that builds into not just investments. It goes outside the arena in terms of estate planning, making sure that we're tax efficient. Like there's plenty of ways to add value and to do things that are going to be valuable for clients without beating the S&P 500. Again, yeah, we would like to do that, but it's just not something that I'm really going to focus on. Because then we end up chasing returns, and then we don't get that nice curve that goes up and to the right that we're really looking for over a long time period to generate the retirement income they need and to educate their children. And we need to do that by having savings and investments that are organized in a way so that someone can maintain their sanity and not lose sleep because of the volatility. My goal is for my clients and our firm's clients is to be able to sleep at night and take the anxiety related to retirement and money away from them as much as humanly possible. And we do that by focusing on the plan and not selling something that's just nearly impossible to actually do. Like it drives me up a wall to know that a lot of the people in this industry are really selling that they're going to crush the market and that they can beat this. And it maybe you can, okay, but there's some luck involved, because to do that, you're taking an incredible amount of risk in some way, and it may never materialize, right? But if it does, then you're not having income that you can outlive, and you're not sending your children to school, and that's what we really care about. So that's what we want to focus on, instead of a bunch of numbers on a computer screen that go up and down or that are green or red. That's just not what we're trying to do here.
Excellent points. Hardest questions. Evan, what's your superpower?
Oh boy, nothing useful, that's for sure. I don't know, picking the worst meal at a new restaurant. I think you've seen me do that firsthand. So yeah, that's probably up there, along with being late to family functions. So
that would be my wife.
Those are my two.
Being late everywhere would be my wife. Vince, what's your superpower?
Well, Neil, my superpower is definitely not reaching things off the top shelf. So, that's not my superpower. I mean, I'm a bottomless pit, so I can eat a lot of food. And maybe that's my superpower, having a bad temper. That could be it. I don't know. So we'll go with eating a lot of food. That's okay. Positive.
Very good. Guys, thanks so much for joining me today. We have a team of financial advisors here, and one of the powers, if you will, is the ability to understand how money relates to your life and how it can impact you over the long term. We can help you too. Simply visit us at cfswv.com. Thanks for watching. Have a great week.